Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Surbhi Upadhyay, and the countdown is on. 1 hour to go for the economic survey. 25 hours before Finance Minister Nirmala Sitharaman presents her 7th budget, and that's going to be a record for any finance minister. 7 successive budget, and look at the markets. We had that big morning dip, and the Nifty has recovered more than 200 points. So the investor appetite is truly strong. The mid-cap index is up more than 1%. Very strong advanced decline ratio. And pull up the contribution plate, Surbhi. HDFC Bank and Reliance Industries are pretty much, offsetting each other, evening themselves out. So that contribution plate will bring that up. PSUs are seeing a lot of buying. So the Nifty CPSE index is again about 1.6%. Fertilizer stocks as a pocket has come in for buying. So whether it's NFL, RCF, Madras FUD, and PSU banks too. So in that CPSE bucket, particularly PSU banks too are shining.
Absolutely. I think, last week we had consolidation and that Friday was a big slam dunk. But I think we're going into this event with hope, and that's what the screen is telling us, because the dips are getting bought all over again. And fingers crossed from the market perspective that there's going to be no major tinkering with the capital gains tax, and more announcements, more outlays for, of course, all the capex intensive, infrastructure intensive sectors, because that's what's really playing out. And the mid-cap bounce back is very interesting to note as well. The index is up a whole 1%. You're looking at a very, very, good-looking screen in terms of the advanced decline ratio. The breadth is very positive. Over 1,600 stocks advancing at this point in time. And who are the winners? Well, Reema mentioned PSU banks, but even other PSUs. That whole part of the market is thriving once again. Look at Mazgaon Dock, 5.5% higher. You've got stocks like Shipping Corporation of India up about 6%. Some of the fertilizer names are very, very excited on perhaps, some sort of policy hopes coming through. So your FACT and RCF, a lot of these names are up and about national fertilizers. So this is the side of the market which is quite excited, which is obviously on the PSU side. But even non-PSU and Indian hotels, the numbers are being very well received. It wasn't a breakaway quarter. Steady growth coming in, but the market's choosing to be optimistic. About 5% up on that stock. You have some of the other names as well that are standing tall. In terms of good result reactions on the mid-cap screens, also look out for Oberoi Realty, blockbuster numbers. So, we'll talk more about this, but the short point is that the market is looking fairly resilient at this point in time. We will start with earnings reactions because it was a very heavy weekend after markets closed out on Friday. We had so many big numbers coming in. So we'll talk about all of the big Nifty heavyweights, starting with the troubled child, the problem child, which is Wipro. The stock is still reeling under pressure. Last I checked, it was still down about 7%. Wipro is still looking at a cut of over 8% at this point in time. So, Reema, I guess it had set itself up for very high expectations given TCS and Infosys, right? So what all went wrong, do you think?
Well, there are two reasons. One, as you said, the expectations were high. The stock run-up was too much. So at the beginning of June, the stock price was 440. And last week, it went to levels in excess of 570. So it was a 30% rise in a span of 45 days. So that's one. And the second is the earnings were a miss. Q1 was a miss and the Q2 guidance. So on the top line, the company's revenue growth has fallen for the 6th straight quarter. And even the Q2 guidance is not very inspiring. They're guiding for -1% to +1%. So brokerages are saying that Kotak, I'm specifically talking about Kotak, they're saying at 21 times forward multiple, the stock is expensive, no margin of safety. UBS says the softer than expected Q2 guidance suggests that it's getting difficult for the company to convert its large deals into revenues. There is a delayed conversion of large deals, which means the drag on growth will continue, resulting in Wipro lagging its peers. But on the other hand, there are many believers in the Wipro turnaround story. So Nomura has a buy rating. They retain the target price at 600. And the other one is CLSA. You remember CLSA with a double upgrade? Well, they continue to keep the faith, outperform rating 588 on Wipro there. But the reason is miss on the earnings, and plus the stock had run up too much, and some of that is being shaved off today. But let's talk about HDFC Bank now. That's a stock which is doing very well, 2.5% gain in terms of the stock price. Abhishek joins in with the details.
Well, to begin with, the surprise on net interest margin expanding on a sequential basis is perhaps what has worked out, for HDFC Bank in terms of investor reward. So P&L, take a look, the NI and PAT is a beat on our poll. NI is a beat of 0.9% and the PAT is a beat of more than 3%. Net interest margin improved on a sequential basis by 3 basis points. Largely, analysts were expecting a flat net interest margin. Now, other income declined by 41.3% sequentially. Treasury gains were about 7,600 crore in the previous quarter. So that's a one-off that has come in this time around. Operating profits declined by 18.4%. However, if you remove the treasury gains, operating profit grew by 9% on a sequential basis. Provisions were down 80.7% sequentially. PAT declined by nearly 2% on a sequential basis. Asset quality has seen marginal deterioration given the fact that agri portfolio is a seasonal in nature. It deteriorates in Q1 when compared to the Q4 numbers. So gross NPA has increased by 6% on a sequential basis. Net NPA has increased by 17.5% on a sequential basis, suggesting that the provision coverage ratio has declined to 71.2% when compared to 74% in the previous quarter. However, as a ratio, gross NPA ratio and net NPA ratio remain under control for the bank. Back to you.
Okay, Abhishek, got that. So that's HDFC Bank. Basically, growth is not happening, but at least margins have surprised on the upside. And that seems to be working for the stock. For Kotak Mahindra Bank, in fact, it seems to be the reverse, Abhishek. Isn't that true? A bit of a margin question over here?
Well, the Kotak Mahindra Bank's results did throw up that the net interest margin is at 8-quarter low. This, despite the fact that the credit deposit ratio has actually improved on a sequential basis, and operationally, it looks like a weak quarter that Kotak Bank has had. So, if you take a look, net interest margin has come in at 5.02%, which is at an 8-quarter low. This is a decline of about 25-26 basis point on a sequential basis and about 55 basis point on a YOY basis. Now, deposits are up only 15.8% YOY and they are down 0.3% sequentially. So deposit momentum on a YOY is the lowest that you are seeing in last 6 quarters, and deposits have shrunk on a sequential basis for the first time in 16 quarters. On the good side, the advances growth at 18.7% YOY is perhaps one of the best that you are seeing in last 6 quarters. Sequentially, the advances growth was 3.7%. Operating profit grew by only 6.15% YOY and they have declined by 3.8% quarter-on-quarter. This is the weakest growth in 8 quarters with respect to YOY growth rate of just 6%. Operating profits, if you remove the treasury part, it has grown by 11.5% YOY, but it has declined by 7.9% sequentially. So provisions are up nearly 59% YOY and about 120% on a sequential basis. This is the worrying factor. They have had an exceptional item this time around. They have sold stake in their general insurance arm, which has got them around 3,520 crores. So that is why the PAT is up 81% YOY and about 51.2% sequentially. So in terms of P&L versus our poll, the NI is a miss. The NI is below our poll. However, due to this exceptional gain, the PAT is ahead of our poll. Take a look at the asset quality. Gross NPA in value-wise has increased to by 3.8%, while net NPA has increased more than 8% sequentially. However, as a ratio, gross NPA ratio and net NPA ratio have remained stable on a sequential basis. Back to you.
Okay, got that, Abhishek. Thanks very much. Yeah, I think the commentary from the Kotak management was also noted by the market, because in the conference call they spoke about some pressures on the credit card side. Reason why they're going quite watchful on that side of the book at this point in time. Unsecured lending continues to be a major area of focus for the RBI and, of course, for banks as well. Thank you, Abhishek, for a detailed analysis on both Kotak as well as HDFC Bank. Now, let's come to the big boy, Reliance Industries. We have Sonia with us to round up exactly how the first quarter played out. Sonia.
Well, thanks a lot for that. So, Reliance's numbers were a mixed bag this time around. While the oil-to-chemicals business was on the weaker side because of macro concerns, there was a stable set of numbers coming in for the Geo as well as the retail business. So if you look at the core numbers, right, the numbers were largely, you'd have to say, in line with estimates. 11.5% growth is what we saw for the top line at 2.32 lakh crores. The EBITDA went up 1%. The margins were under pressure, and that's where the disappointment has come through. Margins coming in at 16.7% versus 18.4%, while the profits were down about 5.5%. But let me tell you what brokerages have made of the numbers. It's a mixed bag from brokerages as well. Nomura said that it is an in-line quarter. They reiterate a buy with a higher target price of 3,600 rupees. Now, Nomura points out that Reliance is their top pick in the sector. But on the flip side, you have brokerages like Jefferies that believe that it was the revenues that were missed estimates this time around. The subscriber addition for Reliance Jio was weak. They say that Macquarie says that Q1 was a material miss because of lower than forecasted Jio as well as the oil to chemicals business. Macquarie also continues to see a downside risk to consensus estimates. They maintain a neutral with a 12-month target price of 2,750. Back to you.
Thank you very much for that. Those were the big stocks of the day in terms of earnings reaction. Get into a break. But as we do that, we strive to get you the best of the market and macro voices ahead of the union budget. So tune in to CNBC-TV18, 9:05 a.m. onwards on Budget Day tomorrow. We will be live from the National Stock Exchange with Morgan Stanley's Rhythm Desai, Dinesh Shah of Kotak AMC, Prashant Jain of 3P Investment Managers, and the NSE MD and CEO Ashish Kumar Chauhan. Welcome back. ITC is a bit nervous in today's trade, so that's down 1.5% ahead of the budget tomorrow. Though Macquarie has actually come out with a positive note where they've initiated coverage with an outperform rating. They've put the target price at 535. They believe the cigarette business has headroom to grow. But there is some anxiety, nervousness ahead of the big event for ITC tomorrow in terms of cigarette taxation. But let's get to the commodity space now. Manisha is now joining in and she's focusing in on sugar prices. Hi, Manisha.
Hi, Rima. Thank you for that. Well, yes, if you look at the international markets, we are now in the negative for this current month as far as the sugar prices go. The global sugar is also trading at a 5-week close right now, and we've seen that decline come in for the Indian markets as well. This is happening because the global sugar stocks for the year 2024-25 are expected to be in the surplus after a deficit that we saw in the previous session there. If you look at the Indian markets itself, well, we are looking at a higher sugar reserve at around 9.1 million tons, and out of this, 3.6 million tons is seen as a surplus as well. So not just India, you are looking at a higher crop in Thailand, in the European Union as well. And as far as Brazil goes, which is the largest producer of sugar, the numbers do look quite encouraging and of course bearish for prices in that sense. So there is a report from Unicab which says that the Brazil sugar output for the month of June actually gained up by nearly 15%. And Conab, which is the agency which comes out with agriculture produce in Brazil, says that the Brazil as a country is looking at a record output up by nearly 12% as compared to the previous year to a record 46 million tons this time around. So for this year now, there are a couple of agencies which have put out numbers. One is Zarnikau, which says that they are looking at a surplus of almost 8 million tons here. And the way the USDA has done their calculation in sense of production and consumption numbers, you can see that the production is much higher than consumption. So it's almost around 8 to 9 million tons of surplus that USDA also seems to be looking at. The other agencies also are looking at higher production and higher consumption going forward. And this is something that could keep the sugar prices globally under pressure. We also have seen a lot of speculative activity actually wrap on its long positions. The open interest has been declining as well. So some more pressure could be coming in for this commodity.
Okay, thank you very much for that. Get into a break. On the other side, we'll discuss market technicals. Soni Patnaik of JM Financial Services will join in with her top trading bets. Welcome back. Some stocks you should keep on your radar. Oil marketing companies, so BPCL is higher, 3.7% in the frontline pack, but even HPCL has a gain of close to about 3.5%. Indian Hotels, Oberoi Realty and Fertilizer as a pack we've highlighted. But now even Chambal Fertilizer has a gain of more than about 5%. So that's a pocket of strength. And in terms of banks, you've got Federal Bank, you've got a Union Bank, post numbers, RBL Bank up 1.5%. So banks too are higher. Dodla Dairy's numbers are up for you on your screen. It's a massive 86% jump in the profitability. The stock is up 10% right now. But as promised, let's invite Soni Patnaik from JM Financial on the show now. Soni, big day tomorrow. What's the setup looking like, and what would be the stocks that you would advise trade on?
Good morning, Reema and Surbi. Thank you for having me on the show. I think Nifty has shown a good bounce back from lower support levels of 24,400, 350. That range is still acting as a very strong support. And on the higher side, 24,600, 650 may act as a resistance. So this is going to be much of a consolidation range, and either side break of these levels can determine a further trend. Any close below 24,400 on closing basis only can determine a correction in Nifty, which can take it towards 24,150 odd levels. So I think that's how the levels are playing out. It's a good short covering today, and on similar lines, even Bank Nifty, you can see 52,000 is acting as a very strong support on closing basis. So as long as it's holding and defending on closing basis, Bank Nifty may bounce back. But if it's able to close below the 52,000 level, you can see correction in Bank Nifty towards 51,500, 51,000. So I think these are the levels to watch out for. As of now, it's just wise to stay away from the indices and look for stock-specific strategies. And in stocks, we have two buy picks today. One would be from the pharma space, Dr. Reddy, which is showing a good 6% fresh longs today. So one can buy in July futures in Dr. Reddy, keeping a stop loss of 66.60 and a target of 68.50 can be seen in Dr. Reddy. The second buy pick is in PI Industries. So it's also showing a very strong fresh long built-up position of 21%. It's quite aggressive, and it's also given a good range breakout today. So PI Industries in July futures, one can buy keeping a stop loss of 38.60 and a target of 39.50 to 4,000 can be seen.
Okay, all right, got that, Soni. Thank you very much for that. So those are some trades that perhaps viewers can work with. By the way, look at Dodla Dairy go. I mean, that's a really, milk-powered performance coming in. Stock's anyway done really well this year. It's up almost 45-50% this year. And then this is a superb surge coming through. The operating performance is absolutely smashing. And that's why that stock is flying away 15% up at this point in time. Pull up a one-year chart on Dodla Dairy as well. And it's done, let's see, about 67-70% in the last 1 year. It's been quite a high flyer. There we go. All right. With that, let's move on and talk about the big story ahead. The budget session of Parliament begins today with Finance Minister Nirmala Sitharaman all set to present the Union Budget tomorrow. The Finance Ministry will also present the 2024 Economic Survey later today. Sapna is joining in with key expectations. Sapna.
Well, this will be the second economic survey of the Chief Economic Advisor, Dr. Anand Nageswaran. He's a straight batter, and of course, the big focus in the economic survey is going to be on India's growth story. We know what the numbers have been like for FY24. For instance, the CA in his previous economic survey had said that the economy may expand by around 6.5% in FY24 with an upside, but the economy has clocked 8.2%, so to say. Also, in the current financial year, the RBI has already raised India's growth forecast to 7.2%, while other important agencies like the IMF, ADB, Fitch, they are somewhere around 7%. World Bank is slightly lower, 6.7% average growth rate over the next 2 to 3 financial years. So it may just be possible, keeping all of this in mind, a 6.75 to 7% growth rate could be penciled in by the economic survey with a leaning towards an upside, or maybe even a 6.5 to 7%. Now, beyond FY25, the CA has already indicated earlier in his various statements that it's easy for India to grow at a healthy clip of around 6.5 to 7%. But beyond FY25, and in the long run, maybe he doesn't want an extremely high growth rate because that can be inflationary. Some of his statements indicate that. But just coming back to the current financial year, 6.75 to 7% with an upside, or 6.5 to 7%. This could be the likely number in the upcoming economic survey. Second, of course, the focus could also be in terms of job generation. Now, the government has been putting out a lot of data on this front. There's a lot of narrative in terms of how the employment story is changing in India over the last couple of years, even last couple of months, which are those sectors. But what else needs to be done? Investment in skilling is very important. The CA has been talking about this. So going forward, you will find a lot of mention in the survey. Last but not the least, in terms of the fiscal side of the story, well, the CA has also been indicating earlier in his earlier statements that the best kind of fiscal stimulus is basically when you maintain fiscal discipline, because that will help bring interest rates down. With inflation trending off, probably there could be some more commentary on this front. We'll have to wait and watch. Last but not the least, in terms of infrastructure development and manufacturing, there could be some mention in the upcoming surveys. So all of this is going to be very important, especially the fact that the survey always comes generally between, just a day before the union budget.
Okay, all right, Sapna, thank you so much for that. We're expecting the document to be tabled this afternoon in Parliament. There's also a press conference. CA will be holding a press conference at around 2:30. And of course, we will keep you up to speed with all the latest. For now, a quick break. We'll come back on the other side and discuss market fundamentals with Ashi Anand of IME Capital.
Welcome back. Let's talk markets then. Ashi Anand, CEO and founder at IME Capital, is now with us. It's a PMS company. He manages two funds. One of them is the Microtrends PMS, where he's got holdings in Shobha, Shriram Finance, Zomato, State Bank of India, Infi, Axis Bank. And the other one, which we've often discussed, is the Digital Disruption PMS, with holdings in names like Zomato, PB Fintech, Nykaa, InfoEdge, Paytm, etc. Ashi, thank you very much for joining in. Let's talk about the Microtrends portfolio, right? There's a big event coming up. Have you made any changes in your portfolio in the last 1 month? Because I was comparing your recent fact sheet with the prior one. It appears that you've increased your cash position, brought down your stake in stocks like Bharat Electronics. So what's the construct looking like?
Firstly, thank you so much for having me on the show, and you've been quite attentive, it seems, in terms of our fact sheets. Yes, we have been kind of repositioning a bit going into the budget. I think at the first level, what is it that we're looking for from the budget? What you have seen is over the last 3 to 4 years, you've consistently seen kind of the budget prioritize capex over kind of revenue expenditure. Now, given the election results and given the fact that consumption has been weak for many, many years, we are expecting some kind of a shift in terms of the current budget, right? And you are probably looking at some level of consumption expenditure increasing. So a combination of kind of sorry, if I can just rephrase. So you're looking at consumption expenditure kind of being increased, but you are also expecting the overall capex momentum to really continue. And I think the whole RBI special dividend, which would have come in this year, would actually help this combined continued focus on capex as well as strong consumption demand. Now, the reason we have repositioned the portfolio a bit going into the budget is last year you've seen very strong growth in overall capex spends, in real estate, in all forms of capital formation. Those parts of the markets have actually done very, very well. And we are expecting some kind of a balance this year in terms of sectors like consumer, IT, pharma, some of these really coming back, and possibly some moderation in the strong outperformance of these capex heavy themes, which is where you've kind of seen. So what we've done in terms of portfolio repositioning in the previous kind of month, what we had done is we had reduced some of our capex and moved towards consumption. Going into the budget, where we have booked some profits from real estate and increased cash to really kind of position based on how the budget comes in.
Okay. So, Ashi, hi. Good to have you on the show. Now, what is the thesis and the base case expectation on capex? I mean, capex is already, the thing is, stocks have already run so much. We may still get good announcements tomorrow, and that could create more of a sentiment boost. Look at the market today, right? It's still celebrating the same PSU stocks. But once the event is out, what do you think is your medium-term positioning going to be on this part of the market?
So I think our medium-term positioning continues to be very robust, right? What you are seeing in terms of capex is after a decade of very, very kind of muted capex spends, you are coming back to kind of an environment where there are multiple kind of drivers of capex which are all kind of firing at the same time. Partly this is PLI incentives. You are seeing some kind of very interesting spends coming in terms of new energy. There is a larger shift in terms of a value migration happening away from China towards India. A lot of these kind of sub-trends which are playing out, all of these should lead to a very favorable medium to longer term outlook in terms of capex. The main call, however, is in terms of shorter term price momentum. I think a lot of this medium to long term story is already partly kind of priced in, and possibly a lot of the short term momentum in the space has been very, very high. So we're probably kind of expecting some kind of a possible time correction. So if you're just looking at it, possibly capital goods companies may not perform as well in the near term, but over the medium to longer term, we still see a lot of kind of value. Now, all of this is just purely focusing on kind of fundamentals. Market sentiment in the space and market momentum in the space continues to be very high. If stock prices continue to be driven more by a narrative than near-term valuations, the space could continue to perform.
You said you've raised your cash holding. So once the budget is out of the way, will you look to deploy it, or do you see an imminent correction in the market and that's when you will look to utilize this money?
No, so I think the cash that we have created is driven more by being able to have some amount of liquidity available to position ourselves on the kind of budget day or immediately after the budget. It's not that we are seeing any imminent correction in the markets. I think the longer term outlook for Indian equities continues to be extremely robust. You are likely to kind of see rates starting to kind of decline towards the end of the year. There's no real reason we're seeing for sharp decline in the overall markets. In certain pockets like small caps, etc., there may be some level of froth. But I don't think so. This is not a structural cash holding. It is kind of tactical creation of cash to be able to position ourselves going into a key event.
Okay. And then one final word then on your digital disruption portfolio, since you track all the listed companies very carefully. Any interesting trends that you've observed in any of the stocks that you'd like to highlight for our viewers?
So I think more than specific stock, right? I think core parts of the thesis are really playing out very, very well. So just to kind of recap what the core thesis is, we believe there are very strong enablers for sustained high levels of revenue growth for these companies over the coming decade, not just over the short to medium term. This accompanied by a shift towards not just profitability, but high levels of profitability should lead to very strong value creation. I think you are seeing this play out very clearly across companies. Growth is sustaining at high levels. Profitability as compared to what people were looking at a year back, right? I think across the board, people are now beginning to realize and understand that these companies are turning profitable. What I think markets possibly yet are underestimating is how profitable they can become over the longer term. How attractive return ratios are going to be, how attractive cash flow generation is going to be. Now, a combination of both of these itself is enough for very attractive value creation. But the whole additional kind of trigger comes in when we're really looking at them entering adjacencies. So if you look at Zomato's entry into Blinkit and the kind of value creation that's happening there, we believe once a platform is built, these companies have the ability to enter adjacencies at a relatively low cost.
Right.
And if successful, this can create a lot of value. So I think we're seeing this very clearly across companies.
Indeed, that's played out very well for you. Thank you very much, Ashi, for joining in. We'll continue this discussion another day. For now, we need to slip into a very short break. But on the other side, we've got a special discussion lined up. Jimit Modi, Deepak Shenoy and Rajesh Baheti will join in to weigh in on the regulatory red flag on the sharp surge in F&O volumes.
Welcome back, and it's now time to discuss the big story. Market regulators in India, as well as the banking regulator, actually seem to be concerned about the rise in F&O volumes and the increased speculation that we've seen in the stock market since COVID. In fact, we'll put the numbers up for you. There's been a marked increase in options trading, both when it comes to index options as well as stock options. Compared to FY21, which was the COVID year. So now the numbers have absolutely ballooned and gone through the roof. This is something that SEBI chief Madhvi Puri Butch actually picked up on. She was speaking at an industry event. It was a SBI mutual fund event. And she went on to say that it is perhaps time to consider if household savings are going into speculation instead of capital formation. She also said that the surge in volumes across futures and options is now a macro level issue. It's not just an issue about investor protection or investor safety at an individual level. Listen to this.
Micro objective of protecting the individual investor has changed and morphed to thinking about the macro issue of saying, is this what our market is designed to do, to basically facilitate a lot of speculative transactions? Or at a macro level, are we worried that household savings are now going not into capital formation, but into speculative activity? What has changed over the 3 years, the facts that have changed, is it has gone from being a micro issue of an investor to a macro issue of the economy itself. Every time we introduce something new, it's because we say we recognize that there is a market demand for it. We need to give a good regulated environment to the investor to meet that demand. So it's clear to us the investor wants to take derivative positions. Why are we leaving him without an option to do it through a professional fund manager? So that was one of the factors that drove that consultation paper.
And the flight of capital from household savings to other financial instruments has got the RBI governor worried too. In fact, both the regulators spoke at different events on Friday, and they both aired their same concerns. Now, speaking at a Financial Express event, RBI Governor Shaktikanta Das said slowing deposit growth can create structural liquidity issues. Listen in.
Household and consumers who traditionally leaned on banks for parking or investing their savings are increasingly turning to capital markets and other financial intermediaries. While bank deposits continue to remain dominant as a percentage of financial assets owned by the households, their share has been declining, with households increasingly allocating their savings to mutual funds, insurance funds, and pension funds. To be precise, households are increasingly turning to other avenues for deploying their savings instead of banks.
All right, so those are both the regulators sounding off a lot of concern on what's going on in the F&O market. Now, we got reactions from a whole host of market participants, experts through the weekend on this, because this matter has stirred up a massive debate on social media. People are really asking the question that, is the increase in F&O volumes really such a big concern? Should regulators be so concerned as long as the markets are behaving in an orderly fashion? However, a lot of participants from the mutual fund world definitely are concerned, and those comments are on your screen. Nilesh of Kotak AMC says that the SEBI chairperson is absolutely right in stating that F&O activity is both a micro as well as a macro issue. From a macro point, there are issue of savers becoming speculators rather than investors. And from a micro point of view, there is a need to create a level playing field between local and global participants in the F&O market. Basically, global participants which have access to big algorithms, high-frequency trading versus retail, which perhaps doesn't have access to that level of technology to trade in the F&O market. That's Nilesh's point of view. Look at Swaroop Mohanty of Mirai. He's saying the number of people who have started return chasing is scary. While the market capitalization and the number of available stocks and free float seems to have widened, what does not change is the liquidity status of the market. Everything is okay until inflows are higher than outflows. The day that changes, it can go in a very wrong direction. We'll keep playing more and more of these reactions that we've gotten some very interesting comments coming in, and keep looking at that screen for more. We also, of course, have a live panel to take this issue forward. Jimit Modi, founder and CEO at Samco Securities, is with us. We'll also have some other guests joining in. I think we've got Rajesh Baheti as well. Rajesh, welcome to this conversation. And Deepak Shenoy of Capital Mind. Gentlemen, I don't know if you saw your Twitter feeds or social media feeds over the weekend, but I think the regulators really set a whole debate in motion. Let me come to you first, Jimit. I think the issue here is this is happening before the budget, remember. There's a lot of speculation about whether there's going to be a change in STT, whether tax should be used as a policy to keep retail away. Now, I don't know how you distinguish between retail paying STT and institutions paying STT, but your thoughts on the matter?
So, first of all, thank you so much for having me on the show, Surbhi. If I was to sort of look at the movement in options trading, and I think bulk of the challenge with the and the comments that the regulators have sort of referred to comes in the option segment. I think that is where the concern lies. And it's important to understand that this shift in the past 3-4 years that has happened, where options volume has increased, is not because of some random increase in speculative behavior. I think a lot of it has been the first order and second order effect of regulatory changes that have happened in the past. There was a new margining framework in 2020. There were peak margin regulations that were introduced in 2020-21. And those regulations resulted in an indirect move of people moving from the future segment to the option segment. That's point number one. The second thing is, do I believe that this is a macro issue? So, if you look at the data and the data where how many people actually participate in the options market on a monthly basis, that number is about 40 to 45 lakh on a monthly basis. So 40 to 45 lakh unique PANs participate trading in index options or stock options on a monthly basis. And this is based on NSE data. Now, is the participation of 40 to 45 lakh individuals out of a population of 140 crore people a macro issue? I think probably to some extent the fact that there has been excessive speculation, yes, but it's not that this is a issue that is impacting crores of households in the country. So this is a small segment of the market which is indulging in very, very high activity. And obviously the regulator is right to look at seeing which are the manner in which they can avoid this excessive speculation. But the fact remains that this is a small micro market of 40-50 lakh people engaging in this business activity every month.
Got it. Rajesh, come in on this. Do you think it's too early to call it a macro issue that Jimit was pointing out? And secondly, what could be the steps? Because collectively, increasingly, we are hearing all the regulators, whether it's the government, whether it's the RBI, SEBI, all of them appear to be cautioning, raising the red flag on this. So what might come out? And especially in the budget, should we expect anything?
So I think it's fair to accept that SEBI and the government is seeing a situation which they don't like. It's something that we need to recognize as an industry. But what's more important is that if you have a problem statement that says that it's the lowest rung of retail or the large retail participation that is bothering you, the steps you should take should be targeted at preventing that portion of the retail segment that you think shouldn't be trading in the F&O segment to prevent them from trading, rather than put some kind of curbs that will kind of dampen the overall market activity and take us back 5, 10 years, 15 years into the past and really damage the entire industry as well as the MIIs. To that, I would have said, and I've said that before, that the best way to target the retail or the lowest rung of retail is two ways. Either put some kind of course, market lot adjustment to 20 to 25 lakhs would be one of the key variables there that would prevent the smallest rung of retail from participating, because whether you're buying options or selling options, I think the cost of margins would go up. The other way to look at it is set a minimum capital adequacy criteria of 10 lakh rupees as margin, irrespective of whether you're buying options or selling options, that you've got to have a balance of 10 lakhs with the broker in order to trade the market, F&O market. You set a criteria like that, I think the lowest rung of retail will go out of the market. Look at the number of UCCs that are trading pre these changes versus post these changes. And if you think you've achieved your end in terms of the number of people accessing the market rather than market volumes, then I think you'll have achieved your end. I think looking at market volumes is not the right way because we've had technological advances from which market volumes have gone up. More importantly, the important variable to look at is the number of UCCs trading in the market.
Fair enough, and I think that's the point that Jimit also made, because the actual number of PAN holders, he said, as per NSE data, is about 40 to 45 lakhs. So is that really such a huge number to get worried about? It's a smaller set of people indulging in a lot of speculation. That's his point. But let me bring in Deepak as well. Deepak, now we'll get to the more in-depth, the broader picture, moral debate on the regulator's role in just a bit. But before that, for a moment, let's admit that this is a problem, because that's what a lot of industry participants are also saying. So how should one fix it? Rajesh is saying, do it via change in lot sizes, not necessarily maybe tax. Do you concur?
I don't think, see, if people lose money, they don't pay tax. So I don't think that's a deterrent. So in the sense that you will look at the lot size, I like the lot size idea very much, because when, SEBI introduced lot sizes, or I think NSE introduced lot sizes, the argument was roughly 100 shares in the US would constitute a lot. Roughly the average stock price that was originally the US market was designed for was $40 a share. So it was $40 into $100, $4,000, 50 rupees to a dollar roughly. So 2 lakh rupees was our lot size. Our GDP has gone up 10x since 2003 or 2002. And then, so 22 lakhs should automatically have become 20 lakhs, but it has become only 5. And secondly, the US average stock price is now probably $200 to $300. So a similar argument would lead to roughly $20,000 equivalent as a lot size that you would have in India, which is about 16 to 17 lakhs. So I think having a 20 lakh or 25 lakh lot size would be appropriate, given the relatively higher volatility in the segment, and you need the sell side of the options at least to be a lot more financially viable. The buy side is, just limited by the amount they put in. But the other arguments are also sound, in the sense of, I would say, even reduce the number of option expiries by, instead of one every day, to maybe 2 a week, one for each exchange, which is probably more viable, because then you reduce that, the footprint of unbridled speculation. Speculation is not bad. It's a good thing. I think even it's a business. A lot of people in this business have come out from next to zero and made a lot of money in the F&O business by doing so. It is not, therefore, akin to a casino, where the casino keeps almost all of the profits made here. Here it is actually spread out between a lot of people, and a lot of people can come in from relatively humble backgrounds and still make a lot of money. So I don't think it's worthwhile to ban it. You should just make it a little bit higher in terms of raising the bar in terms of entry, so that some of the least, the lowest end is raised by a little bit, so that you have to spend at least 50,000-60,000 rupees just to participate, and that will deter a lot of the smaller players here.
Got that. Deepak, we've been running your court play too, where you've said the speculation in F&O does not cause a banking problem. Could you explain that a little bit?
Yes, so let me run this by, if you look at it, no matter how, if I take my money out of my bank account and use it on F&O, I give it to my broker who's got a bank account. That broker will upstream it to the clearing corporation, which has a bank account. All this money is invested again in some kind of banking asset, right? So it's still part of the banking system. So there's no structural liquidity problem at all. The RBI governor actually said it in a different way, and he said there's no liquidity problem per se, but you have a problem at a single bank level where you depend so much on CASA, your current account, saving account, where you give no interest. And therefore, people get smarter and say, listen, let me put it in money market funds. Let money market funds invest in wholesale deposits for banks, which come at 7% rather than the CASA, which comes at either 0 or 4%. So the cost of your funds is going to go up. And if you keep depending on CASA, you will have a liquidity problem at an individual bank level. But the banking system is not going to see a liquidity crisis at all. And it doesn't make any sense for a banking liquidity crisis to be created by something moving from one bank account to another bank account within the banking system. Liquidity crisis either comes from money going out of the banking system by the government collecting too many taxes and keeping the money in and not spending it, or people turning their money into cash, which moves money out of the banking system. It doesn't happen this way. Speculation will not change the way bank liquidity is as a systemic at a systemic level. But individual banks have been very lazy. They don't raise deposit rates and they crib that people don't put deposits in them. So I think this is not a banking liquidity problem at all.
We hope it stays that way, though that's a different debate altogether on, if it were as simple as just raising interest rates and getting a lot of deposits. I don't think any of the banks would be complaining. That's a different debate. Gentlemen, I think we need to do a longer one on this. We're constrained by a lot of earnings also coming in today and all the pre-budget stuff. We promised to get you back to answer the bigger sort of moral issue around this. Should regulators really have a role as long as the market is orderly? Thank you so much for joining in. As we take a break, I just want to pull up that quote plate from Ajay Bagga, who answers that question. Maybe we'll have him on the panel. He says, and I quote, regulators' mandate is market stability and integrity and, yes, investor protection from Ponzi schemes. But their mandate is not investor returns protection. Then you will always have infantile behavior-oriented investors who take credit for bull market returns and blame regulators for losses in corrections. I feel this is a regulatory overreach. This is a big debate. It isn't ending now. We'll have the panel back here and maybe Ajay as well to take it forward. Right now, a quick break. More on the markets in just a bit. Welcome back. Here with us on Trading Hour. After regulators spoke out against the surge in F&O volumes in equities, fears have risen that the government too may weigh in with higher STT, securities transaction tax on futures and options. Lata is here with the likely impact cost. Lata.
Well, I just want to point out that the STT was never imposed with the idea of making too much money or putting hurdles. It is a very minute tax, and I'm just giving you 3 examples. For a delivery-based sale of share, the percentage is 0.1 of the price of the share. But look at the option. A sale of option in a security is 0.6625% of the value of the premium, not of the strike price and not of the final lot as well. So if you, and then of course, where it is exercised, it goes a little higher at 0.125% of the settlement price. There it may be a little more. But let me tell you what the impact is. Take, for instance, premium of a Nifty option. The range is anything from 20 rupees to 4,000 rupees, depending on the strike price. Now, at 0.0625%, the tax on one option, even at 4,000 rupees, works to 2 rupees 50 pice. A lot size of 25, that multiply it, it will become 62 rupees 50 pice for a total premium value of 1 lakh. Now, even if you double it, do you think it is going to impact the cost of a person who is hell-bent on doing this option? So tinkering with the STT, I don't think will be something the government will embark on. It may go for something else, like STCG only on option gains could be increased. We don't know if a subcategory would be created. But as, Deepak Shenoy just pointed out, hardly anybody is making any gains. So, short-term capital gains on that won't help. No, if it is for foreigners, if they are coming through the Mauritius route, will the tax apply? So, you have to think on a different line, but I don't think STT will be the way they'll go ahead.
Okay, well, thank you for revising the rates for us. Important to keep in mind. Anything can happen. We're just 24 hours away from the impact line. Thank you so much, Lata, for joining in. And that is the big issue around retail speculation. With that, we're completely out of time on this edition of Trading Hour. Many thanks for watching.